waiting room. So good evening, everyone. Thank you for joining us for our webinar on what's happening in the market and how we're navigating it. We are pleased to have our own Rob Taylor, wealth advisor and managing partner, presenting. Rob will be talking for 20 minutes. Please put your questions in the chat so we can try and answer them. And if your question is not answered, we'll reach out to you next week to try and answer them. You'll also receive an email after this webinar with a link that you can click on to schedule time with Rob if you have additional questions. Please keep in mind that you will be muted during the presentation, and we will be recording this webinar for those who could not attend. Thank you again for taking the time to join us. The presentation will begin shortly.
Okay, thank you very much, Caroline, for that lovely introduction. And thank you, everyone, for joining us today on Friday, March 14th. I know it's been quite an interesting week in the markets. And one of the things we'd like to start out and talk about is when we talk about what's happening in the markets and how we're navigating it, I want everyone to take a step back and think about one thing, that many times what follows the worst days in the market are some of the best days in the market. For example, today, the NASDAQ was up 2.61%. The S&P was up 2.11%, and the Dow is up 1.7%. Why do you hear me mentioning that? Because in the last 10 years, if you missed the 45 best days in the market, your returns in the market would be flat, right? So again, this what we're experiencing right now, we believe is more of a garden style variety correction. What we mean by that is this is a correction that is probably helping wring out some speculation and leverage in the market. It's healthy, especially for long-term investors. Is it something that is very upsetting at times because you see your portfolio going down in value? Absolutely, we completely understand that. But we think that corrections are very good for long-term investors because it helps build a solid foundation to grow your assets on. So let's move on from here. And one of the things that people ask us, and this is me, and in the guide to the markets, is that how unusual is this type of correction? We saw a 10% correction earlier this week in the S&P. Well, if you look back just over the last few years, we've had corrections of 8%, 10%, and more over the last several years. And the average intra-year decline is about 14.1%. So these types of corrections, although a little bit disconcerting, are not unusual, right? Again, it's how do you get the speculation and the leverage out of the market? And that's what this is all about. So again, fairly normal here. Again, a little bit upsetting. And yes, we do have a new administration in place. So that basically brings in some other concerns for people. But again, we're seeing here in the markets is not out of the normal. The other thing we'd like to talk about is one of the reasons that you've seen a bit more volatility and quickness in this downturn, but again, we see quick downturns all the time, is that the S&P 500 was heavily weighted towards 7 or 8 stocks, basically referred to as the Magnificent Seven. A UBS analyst recently referred to them as the Maleficent Seven, the evil witch in Sleeping Beauty. And as you can see here, if the Magnificent Seven year to date, and this was from earlier this week on Wednesday, is down almost 14% year to date. If X the Magnificent Seven, the S&P is basically flat for the year, right? And the S&P overall is probably down 5 to 6%. This year, it actually did tail off at the end of last year, hence the correction. So we're saying here is that you saw an S&P 500 that was getting a bit heavily weighted towards 7 to 10 names. And basically what you've seen is as those names have pulled back a little bit, they had an oversized impact on the S&P 500 as a whole. It's one of the reasons that diversification in the portfolios are so important. It's one of the reasons that we look to invest you in things that are complementary so that everything doesn't move in unison. The most important thing in the portfolio is to make sure it's something that you're comfortable with, right? So the most important thing that we want you to get out today is that the best investing is long-term investing and to stay invested. So here we're looking at the consumer confidence in the stock market. As you can see, sometimes when consumer confidence starts to wane, those can be some of the best times to be entering the market. Now, consumer confidence came in today at just over 57%, so it's down a bit from here. But then, if you do look at this, you look at the correction that's taking place, we believe that, could we go down further in the markets? Absolutely. But again, we feel this is more of a correction. We don't see a recession on the horizon. We think that this is something that we are going to basically see as a blip down the road and we can move forward from. And the other thing we want to talk about when we talk about time in the market is staying invested in the market. And also, many times people ask us, well, what's the best time to get in the market? And believe it or not, if you invested at times of all-time highs here, what this slide really shows you is that your returns are actually better than if you just invest on any day, right? But I think really the bigger point here is not whether you should wait for an all-time high to invest or what have you, but it's time in the market. It's getting invested, it's staying invested. We've had many instances where clients have contacted us in the years past. I remember this during the pandemic specifically, where they were very concerned. They wanted to pull back out of the market completely. We would talk to them basically if that's what they wanted to do, we did it. If not, we basically found a balancing point. And in I think all cases, a month or so later, they were happy that that was the decision they made because the market had bounced back. And instead of locking in their losses, they were able to participate in that bounce back in the markets. Now, when all of this is happening, at here, we're not sitting and just watching it happen. We're actually looking at everyone's portfolios and we're determining what can we do at these points in time to help our clients. And we have our lists that we start going through. Now, here's another thing I just wanted to show you, which is about different asset classes and how they're performing right now. One of the changes so far year to date is we're starting to see developed market equities outperform. That's basically international markets, developed international markets doing quite well. And really the US not doing as well this year. Again, if you remember from earlier this year, we also talked about we were not too really constructive on small caps at this time because we were worried there could be volatility. We were concerned about higher rates. And as you can see, US small caps are down over 9% year to date. So again, part of it is looking at the economy, looking at how things are setting up, and basically determining when you want to tilt into things. The other thing we started doing towards the end of last year is we actually started increasing exposure to hedged equity positions, equity premium income positions. We started equally weighting the strategies that we use because, again, we felt that equities had a nice run. There was potential for a bit of a pullback, and that we also felt that we're becoming a bit more constructive on fixed income because the returns were becoming a bit better than they had been. Because if you remember, before 2022, for about 15 years, fixed income had very low returns. So what are we looking to do here? We have 9 strategies that we go through with our clients when we're looking at their portfolios and what to do. One is making IRA or retirement plan contributions, sooner than later, because if the markets have pulled back a bit, it's better to buy things at a discount than it is to buy things on a premium. The stock market is one of the few places that when things go on sale, people tend to try to sell them. When people are a higher price, they try to buy them. So again, we feel that can be an excellent entry point for people that have cash on the sidelines or they're looking to fund their retirement plans for the year. Roth conversions, we've reached out to you about doing full or partial Roth conversions. Why? Because again, if a certain stock is down 20%, you can basically convert 100 shares from your IRA to a Roth at a 20% discount, saving on taxes, and then potentially and generally experience the upside once it's in the Roth. So again, a good decision to do there. The other thing is tighten your cash flow. To the extent that, there are impulse purchases or discretionary spending, maybe hold off on that a little bit if you're feeling a little bit anxious. So that's another thing we talk to clients about a bit. If you are thinking about retiring sooner than later and you're getting nervous, hold off a little bit. Again, for most of you who are retired, we've looked at the portfolios, we've looked at your plans, things look very good. But at the same time, if you have options, you can take those options. Several of you have some significant cash sitting on the sidelines. There are some good opportunities here that you may want to consider moving some of that cash in, given the current frame. It doesn't mean that markets can't go down more. It just means that the market is becoming a lot less fully valued, and I say more fairly to undervalued. And I do think we're starting to enter into what we would consider as an oversold position. Rebalancing portfolios, we're probably going to look to rebalance portfolios in the next month. We were doing it right along. But after you have a pullback like this, where for the most part fixed income has gone up and equities have come down, it is a good opportunity to rebalance, move a little bit more from the fixed income into the equity side, and hopefully take advantage when the upswing takes place. Basically also we want to make sure that there have been a lot of gains in many of your portfolios, right? And there has been a pullback here. but we are very cautious in going through and just doing a lot of trading to make sure we're not going to experience capital gains when it's not necessary, right? So even in this type of pullback, many of you still have gains in most of your positions. So are we going to look to potentially reallocate? Absolutely. But we're not at a point where there are heavy losses that we would consider doing across the portfolio. Again, number 8 kind of talks in the same aspect of the rebalancing part of this, which is because of this pullback in equities and fixed income going up a bit, you may see a portfolio that was 60-40, 60% equities, 40% fixed income. Now more like, maybe 45% fixed income, 55% equities. And that's an opportunity to potentially rebalance, increase the equity position because equities are a bit fairly or attractively priced at this point in time. The other thing you may want to consider right now is gifting and estate planning strategies. There are several of you that have estates that are above the lifetime limits, and this is a good time to again do some gifting, move some stocks that may have gone down in value at this point in time, and gift it at this time, or to whether it's relatives or to charities. Again, this could be a good time to do it. I know it's a bit scary. You've just seen your portfolio has gone down in value. Again, with Roth conversions, you're saying, Rob, I could hit with a tax bill. Yes, in the short term, it can seem a little bit, kind of clench your stomach a little bit. But we've always gone back and shown some of the Roth portfolios after these conversions, and they turn out to be very nice, and people are very happy with them. So again, what we're looking at here, we believe is a correction. Could the market maintain volatility? Yes. There are, regulatory and policy decision changes that are happening in this new administration. There are many clients who've expressed to me their deep concerns about this administration. I will go out on a limb and say that right now, this current administration is not exactly my cup of tea, but the administration that we have, we are looking here from a regulatory and a policy standpoint on how best to invest. So rest assured, we are agnostic when it comes to those types of things. With that said, Caroline, I can go on a little bit further, but if you do have some questions in the chat, I'd be more than happy to answer a few right now.
Hi, Rob. So thank you for that. Based on some questions, I would like to ask you, why do you think this market went into a correction?
Why do I think this market went into a correction? Good question. I think there's a couple reasons for that. One is that usually the S&P trades around a multiple in the high teens, 18 or 19. The S&P started getting to a multiple in the low 20s. So it started becoming very fully valued to highly valued. And what that means is that it's basically priced for perfection. So anything that goes wrong could cause a problem, right? Or anything that's perceived that could go wrong could cause a problem, or simply uncertainty. People aren't sure what's going to happen. Right now, people are concerned about tariffs. That creates uncertainty. In times of uncertainty, people want to get paid a higher risk premium. Therefore, riskier long-term assets tend to go down in value.
Thank you, Rob. That's helpful. I'm going to ask 2 more questions. I think the next one kind of connects to that. I think some people might think that this correction is different based on some of the policy decisions like tariffs. So how could people protect or hedge their portfolios from issues like that?
So if you are concerned about that this could be a different type of correction in that, we are, again, and many of you know, we use like some of the hedged equity solutions from JP Morgan. Some of them have become very attractively placed at this point in time, where over the next month and a half, there may be, say, 1.5 to 2% downside and 7 to 8% upside. So you are protecting on the downside pretty well with some good upside. We actually placed trades in those accounts late last week and early this week already. But if you said to me, you wanted to pull back on some of your pure equity positions and go into that type of positioning, would make perfect sense to me. We wouldn't be against that. We also would say that maybe talk to us and say, I don't want to really rebalance my portfolio right now. I'd like to keep a higher percentage in fixed income, right? So I think that's another thing to consider as well. But again, we think that tariffs are going to be more of a several month issue, not a several year issue. And we in the investment strategy we're looking at here, we're trying to look past the next couple of months because we do think there'll be some volatility both in up and down. But we do think, but the other thing is timing the market, as we talked about earlier, is really not an attractive way to go about things. Time in the market is much more important because if you had gotten out of the market yesterday at the end of the day, you would have missed some nice returns today.
Thank you, Rob. That's really helpful. And I think something else that's really important to remember is that while headlines about international tariffs can trigger these market reactions, their actual economic impact is typically minimal, representing just 1 to 2% of government revenue compared to individual and corporate taxes at 60%. So I think that's also important to remember. And then I think my last question to you, Rob, is what is it most important for investors to do now or just think about at this time when investing?
I think the most important thing to think about is the fact that the best investing is long-term investing and realize there are parts of your portfolio that are less risky that we anticipate you'll be taking monies from for distributions in that over the next couple of years or 2 or 3 years. And there are parts of the portfolio that are very long-term that are, 5, 10 plus years out there. So especially in the longer term parts of the portfolio, it tends to make sense to invest for the long term. In the short term part of the portfolio, by default, we are already putting you in positions that we think will be less volatile in the short term. Again, our fixed income exposures in most of our strategies is higher than it's been in years simply because interest rates are more attractive. And again, we are always looking to leverage the hedges in the portfolios when it makes sense.
Excellent. Thank you very much, Rob. I'll also say thank you again to everyone who's tuned in to today's webinar. Please feel free to email me or Rob. You can reach me at ctaylor@carsonwealth.com for any additional questions. Same thing with Rob. And again, you're going to be getting an email with a link to schedule with Rob's calendar after this presentation. So if you'd like to talk further, that will be available to you. We're also going to have another market webinar on Tuesday, April 8th on volatile markets and your wealth with Connor Fitzgerald, an executive director at JPM Asset Management, and our very own Rob Taylor, managing partner. Be well, everyone, and take
One
care.
last thing I would just like to add is
And one last thing.
and the recession fears is that one of the key things to consider is that oil prices have dropped to about $70 a barrel. Generally, if the US economy is heading into a recession, energy prices are spiking well above $100 a barrel. That's not what we're seeing here. So those lower energy prices should actually reduce inflation, reduce cost on goods, and that's good for the consumer. And we are a consumer-driven economy. 70% of our economy is driven by the consumer. So again, we think there are some things structurally here that are very sound, that are good for the markets and good for the economy.
Thank you very much, Rob. I hope this was helpful to everyone. And send us an email, call us if you have any questions. Really appreciate your time. Thank you.
Thank you, everyone.